Massive economic data just dropped, and it's a roller coaster from spiking jobless claims coming in hot and signaling a weakening labor market to the PMI flashing mega strength. We'll also unpack scorching home sales data amid skyrocketing interest costs that are crushing affordability and cap it with a jaw dropping new chart in our Silent Depression series. Is recession knocking or is growth about to explode? Let's take a look. So here's initial claims data. This came in today, significantly higher than expectation, 235,000 initial jobless claims versus 224,000 expected. This is a significant beat, but there is week to week, month to month noise with initial claims. So I threw on the 12-week or 3-month moving average for initial claims. We can see that here in August, September 2023, that moving average hit 244,000. Well, we are quite close, 233,000 to setting a new high in that 12-week moving average for initial claims going all the way back to the end of 2021. So here's continuing claims, and these have been headed higher going back to the end of 2022. That was the bottom in continuing claims. These today came in hotter, 1.97 million versus 1.96 million expected. We can also see that moving average in red. Again, that is the 12-week moving average. Continuing claims bottomed many years ago and have been headed higher ever since. We can see that even the moving average, the 3-month moving average, now at 1.95 million. Again, this goes all the way back to the end of 2021. Another thing that I thought was interesting, here is a chart Zero Hedge put out. This is continuing claims data for just Washington, D.C., Virginia, and Maryland. And we can see the effect of Doge on the bureaucracy within the Beltway. Continuing claims headed much higher there. So we also got Philly Fed Manufacturing Business Outlook Survey. This is soft data. This is one of those surveys. Now, remember, the Fed has many regional banks, and this particular report is looking at within the Philadelphia region, the region that the Philadelphia Fed represents. So hopefully that's clear. This is not a national survey. This is only for their region. And a couple important things that came out of this report, which I will link in the description. The current general activity index plunged from 15.9 in July to negative 0.3 in August, signaling a sharp slowdown in regional manufacturing with an even split as we can see here, about 33, 33, 33, indicating both increase, decrease, and no change. So very evenly split in terms of the outlook for the respondents to this particular survey. Here is the chart showing future activity or expected future activity versus current activity. And what I want to point out too, another notable finding from this survey was on prices. So new orders index dropped 20 points to negative 1.9. That's a first negative reading since April. And, maybe a story of weakening demand. Prices paid index surged 8 points to 66.8. This is the highest going all the way back to May of 2022. And so those input costs and the concerns over them with tariffs and PPI that we did a report on last week, we got some hot PPI data. All of that is kind of pointing in the same direction. Now, Philadelphia Fed new orders index, again, 6.5 expected. We came in at negative 1.9. Now, remember, with a lot of these surveys, anything above 50 is considered, like with the ISM, anything above 50 is considered expansionary. Well, with this particular survey, the way the data is displayed, 0 is the baseline. So anything above 0 is positive, expansionary. Anything below is contractionary. And again, we came in at negative 1.9, significant miss compared to the 6.5 that was expected. So we also got PMIs here, and I made a couple notes. I will link this in the description as well, so you can read through the whole report if that interests you. But the composite PMI output index climbed slightly from 55.1 in July to 55.4 for this month, the month of August. That is a 8-month high and the strongest back-to-back expansion in over 3 years, consistent with 2.5% annualized GDP. Remember, GDP is the aggregate economic output of an economy, and GDP, the way that they're referring to it is real GDP, not nominal GDP, which includes inflation. They're referring to real growth running at a rate of 2.5%, at least according to this composite PMI output index. Another interesting finding, the manufacturing PMI jumped to 53.3 from 49.8. That is a 39-month high, with output surging at the fastest rate going all the way back again to May of 2022. This is driven by both domestic and export demand, both good indicators if you're a domestic manufacturer. The average selling price rose at the sharpest rate since August of 2022, fueled by the steepest input cost increase going all the way back to May of 2025. Clearly, tariffs were implemented in April, and we're starting to see that. Again, remember, PPI leads, right? Producer Price Index. What is going on with producers leads CPI. And we will take a look in a second at this ISM report and the correlation that it has to both real GDP and the leading indicator, like the way that it can predict unemployment as well. So clearly, tariffs having an effect. Again, I will link this PMI report in the description. I do also want to note that Zero Hedge put out an article and noted that this was a 7 sigma beat in terms of this PMI survey that was put out. And so you can find that. We always thank Zero Hedge for the great charts he puts out, and he does good work. So here is ISM PMI in white. This index baseline is 50, so anything above 50 is expansionary, anything below 50 is contractionary. ISM PMIs have come in very cool, going all the way back to July of 2022. They have been below 50. I think there was 1 month where it was slightly above. And so we're hanging out in contractionary territory. Well, look at the correlation that it has to real GDP on a year-over-year basis. We can see that it is heavily correlated, very tightly correlated to real GDP. And it can be a leading indicator for unemployment as well. So if you look, for example, when the ISM starts to roll over, we're looking here at the springtime of 2004. We can see ISM PMIs were coming down as real GDP was as well, and unemployment was actually coming down. So PMI started to go negative here, and in April of 2007. Unemployment didn't start spiking for another couple months. And this is true if you look here, ISM PMIs started to roll over. Unemployment was actually going down. So labor market was indicating strength. It wasn't until a couple months later that unemployment rate started to spike. So it can be a very useful business cycle indicator. When people talk about the business cycle, ISM PMIs is a great way. Zero Hedge noting this was a 7 sigma beat upwards in terms of strength that ISM PMIs is indicating. Now, our general base case for the next, call it 9 months, 12 months, is a reacceleration of nominal growth, including real growth, real GDP, but also inflation. That is nominal GDP, the two combined. We've been saying that since, I think, May. And so far, ISM PMIs are supporting that. Core CPI started to accelerate, now above 3.1%, PPI above 3%. Nominal growth is probably set, in our opinion at least, to accelerate. And so PMIs are just kind of one more indicator of that. I also want to note for those that got the membership, the Discord, I think it's finally working. So that's pretty cool. If you guys want to hang out, there's like an econ room, we have a markets room, and then we have a silent depression room. It's still a work in progress, but cool way to hang out, have some back and forth with people if you like that. If not, we will continue doing the 5 or 6 videos for free on YouTube. So it's just one of those extra things that if you would like, it should now be working. So we also got existing home sales came in very, very hot, at a 2% month over month rate of change. Now, you can see there is a ton of noise with this month over month data set, as is common with month over month data, but a 2% expansion in existing home sales on a monthly basis. This came in way higher than expected, which was negative 0.3. So the housing market, despite existing home sales being at lows not seen really since the GFC and the housing crisis, we can see down here the scale for existing home sales over here on the far right. We can see that despite existing home sales being near GFC lows, we know prices are hitting all-time highs. And if you look on a existing home sales basis on a month-over-month basis, this is starting to indicate that it is maybe the housing market is starting to accelerate. Now we know from our housing videos, the average mortgage size has been going down as the average home price has been going up. So the indication from that is cash buyers are starting to kind of step in to kind of bid up housing. And now we know housing is a massive issue. We will look at in a second at why housing is an issue. I will also note I did an interview with Zachary Loft on Instagram. I think he's mainly on Instagram. We did a whole hour and a half interview. We talked a lot about housing. So if that is interesting to you, Zach's a great guy. It's a great talk. Might find that interesting. Unfortunately, though, I do not see material decreases in housing from the data I'm looking at on a national basis. Now, locale to locale, city to city, yeah, you could see, 10, 15, 20% maybe decline. But on a national basis, the housing bears have been wrong for like over 3-4 years. They've been calling for a crash, it has not come. In fact, home prices on a national basis continue to head higher. Well, if you look at that average mortgage size, it's going down. So what that indicates, and that is common, that you see the home price start to accelerate from, faster than the average mortgage size. You see that in the start of a housing bull market. Sure enough, we are seeing that to the extreme where the average mortgage size, normally it's going up with the home price. It's just the home price is going up faster. But this time around, we see the average mortgage size going down despite the average home price going up. So very likely we are going to see no material benefit for housing affordability, unfortunately. And there's two reasons, or mainly three reasons for that. So here is the average annual interest on the average home. So we can see, for example, here in August of 2020, you were paying about $9,000 per year in interest on the average house. Well, that number is now 27,000. And this is just the interest expense on the average home. This basically 3x'd in a matter of 5 years. Now, if you look at the mortgage rate, it did not move as materially as the white line would indicate. Now, we certainly saw a breakout of the 70-year downtrend in rates. This goes to the Ray Dalio, Peter Turchin, Neil Howe, long lifetime interest rate cycle theory, structural demographic theory, and that is part of this. We are entering a new secular market when it comes to rates and debt and that sort of thing. So, the likelihood that we ever see 2-3% mortgage rates is probably pretty minimal. Now, there's a number of reasons for this. Number one, let's talk about rates. So we can see that the rise in the long end of the yield curve, as measured by the 30-year or the 30-year mortgage rate, has had a material impact on home affordability. This 3x'd almost in terms of the average annual interest. So we got to talk about what is the 30-year going to do? Well, we have the Trump admin basically full on admitting that we're going fiscal dominance. And again, 70 years, if you go back 70 years, that was when the Fed was granted independence with the Fed Treasury Accord. Well, we're going the opposite direction. It's no coincidence that it is happening as rates are breaking out and we are entering a new secular rate market in terms of the long-term debt cycles. So you have a reversal of the 1951 Fed Treasury Accord and fiscal dominance, where the Fed is no longer acting in the interest of inflation and unemployment, but is now acting in the interest of fiscal and interest expense, which is the fastest growing budget item, now over $1.1 trillion per year, $3 billion per day that the US government's paying in interest. And so what their solution is to shift even more issuance into bills, very stimulative, very cash-like, and run negative real rates. Well, that will cause long end rates to go up. In fact, if you look at this cutting cycle that we find ourselves in, That's exactly what rates have done. The Fed has cut rates by 100 basis points, and the 30-year yield, which the mortgage rate is based off of, went up by 100 basis points. So we are getting a bear steepener in the yield curve, and this has never really been seen before, at least in the US, in a rate cutting cycle. So the expectation from people like Pulte that, oh, we'll just cut the federal funds rate by 300 basis points. By the way, core CPI is above 3%, so likely headed to 4 or 5% in that case. You will just cause long end rates to go up. That is what the data suggests we will see. That is what we have seen if we look going back to September of last year, right before the election, when they cut rates. So long end rates will go up. That'll push this line higher. Well, also, there's going to be on the demand side a stimulus with lower rates. And there will be, in the general economy, running negative real rates at the short end of the yield curve, issuing even more issuance of the debt issuance in bills, which are more cash like, more readily levered into new US dollars. This is going to have a positive effect on asset prices. The K shaped economy will get worse. Asset holders will do very well. Unfortunately, for people like me that worked really hard for 15, 16 years to one day have that middle class life, it is looking increasingly like the situation will even get worse before it gets better. Now, as long end rates go up, as we get more of a bear steepener or steepness in the yield curve, long end rates above short term rates, as that happens, that's what constrains the housing market, car loans, credit card loans. So eventually, what we will likely see is long-term rates start to have such a constraint on the real economy that they have to do an operation twist. First they'll try fiscal dominance with their new Fed chair and all of that. They'll get negative real rates, shift all the issuance into bills, very stimulative, very inflationary, very dollar negative. They'll do that first. And then maybe 9 to 12 months later, long end rates will be so kind of high and having such a constraint on the real economy, they will have to do an operation twist where they issue short term bills, raise dollars to then buy down long term rates or QE or even maybe yield curve control. So that's kind of how I see the rates picture headed over the next, call it, year or year and a half. But again, asset prices, including housing, as the M2 money supply expands, land banking has been around for hundreds of years. The wealthy, those with money, put their money into scarce assets. That is what protects them from debasement. Here we can see the effect of that debasement in red. Here we took the total annual civilian wages divided by the M2 money supply. And the way that I got this total annual civilian wage number was I took the average hourly wage, multiplied it by the average annual hours worked, and then multiplied that by the labor force, how many people were working at that point in time, and we get total civilian wages. Then we have to look at it as a share of the M2 money supply. Why? Because inflation is a monetary phenomenon. As they print more dollars, those more dollars are now able to chase a relatively scarce amount of a good like housing, which should be a utility good, but has built and accrued a monetary premium baked into it as the wealthy, whether it be private equity or the average boomer down the street that's got a few million and is trying to preserve his wealth, they will go into scarce assets. Housing is one of the best or kind of the biggest within the kind of American dream, the framework here. It is the cornerstone. People buy housing often on leverage, and that leverage is very beneficial, generally speaking. And so you get 10x leverage to a scarce item that optically goes up in price in a nominal US dollar basis as more dollars are printed to chase the same amount of that scarce good, which is housing. And so, of course, supply is also a factor, but supply is less of a factor than this. So we established the interest rates are crushing new home buyers. The average annual interest expense increased just in the past 5 years by 3x. Well, if you look at the purchasing power of that civilian wage, that average American's wages, again, you have to denominate it by the money supply because inflation's a monetary phenomenon. You have to look at what the money supply is doing. Well, wages as a share of the money supply have decreased by 50% in the past 50 years. If you look at it as a share of GDP, uh, total wages as a share of US GDP have declined by 35%. So, another way to think about this is not as much a purchasing power story as hopefully an explanation and an illustration for people that GDP is useless. GDP, when the talking heads on TV, when the politicians talk about GDP, what good is that GDP if your wages are not growing in line with it? So that is kind of what we're looking at here. How have wages done relative to GDP? If GDP has outpaced the total civilian wages, this line will go down. And ideally, what you would want to see is a pickup where wages start to outpace. They're both growing, but you want to see wages start to outpace GDP. That is what a recovery would look like. We've had maybe 2 or 3 months of that, 2 or 3 quarters of that recently. Hopefully, that trend accelerates. Hopefully, it is another kind of long lifetime sort of thing, because this is just absolutely brutal. Not only are interest rates not coming down, even with Federal Reserve cuts, and not only have they 3x'd, causing your average annual interest to go from 8 or 9,000 to 27,000 per year, but the purchasing power of the wage that you're earning is declining. It's declined by 50% since 1975, and as a share of US GDP, declined by 35%. So if you totaled up all the wages, this used to equal about half of US GDP. And now that number is just 32% of GDP. If you look at it relative to the money supply, it went from about 86% of the total M2 money supply to 44%, a drop of 50%. So not only are interest rates crushing you, having increased 3x, but you also have your purchasing power of your wage going less and less far. So this is really what's driving the housing crisis. Housing priced in gold is actually at an all-time low. So the story is wages. The story is purchasing power of wages. Of course, home prices are high, but the problem for most people is that they can't wrap their head around the dollar has been debased by so much over the past 5 years that is just the new price. We are unlikely to see a material national decrease in the average annual home price. So just to recap here, initial claims came in hot. Again, labor market normalization. If we look at continuing claims, for example, on this chart, so it looks very bad if you look at the past 2 or 3 years. But if you look what continuing claims are now relative to history, to historical averages, we can see 1.95, 1.96. This is near historical lows. So really what's going on in the labor market is more of a normalization period. Obviously, we had 2020 and 2021. There was a huge amount of kind of crisis within the labor market and instability and disruption. So what we are seeing now is just a normalization. Now, unemployment can always get away from them, and the Fed has noted that they are certainly keeping an eye on the labor market. But in general, what Jerome Powell and the Fed are more concerned with, according to their minutes that were released yesterday, is inflation. And that is probably the right approach to take. The labor market is just normalizing after 5 years of, kind of historic amount of volatility and disruption. We also had Philly, new Fed. I'll put that report again, came in weaker than expected. But then you have ISM PMI, which is probably more meaningful, coming in very hot. Again, 2022 highs. And of course, this is a good indicator for where the economy is likely going to go in terms of real GDP and the labor market and the unemployment rate. Again, remember the unemployment rate on a headline basis, the U3, is still near historical lows, as we can see from this chart. And of course, despite existing home sales being basically at GFC lows, people are still buying. The home sales are growing 2% on a month-over-month basis. We know prices are at an all-time high, and unfortunately, not likely to improve meaningfully because Fed rate cuts will cause a yield curve steepener, and long-term rates are likely to go up as the bond market worries about inflation, about fiscal dominance, and all the various kind of themes that we have been touching on for the past month or two. So anyways, hopefully that was helpful, and I will catch you in the next one.